if you had a holiday home in France or Spain or Portugal or anywhere, and you sold that, even though you're not resident in those jurisdictions, they'd tax it. Most other places do. They tax it. So with that in mind, it would be well handy, would it not, to be able to make a gift of an asset, claim gift relief, so you don't have to pay any tax, but have the recipient of that asset somebody who was not resident in the UK, whether that somebody was a relative living abroad, or a company that you had created abroad, or a trust that you had created abroad, or there's all sorts of permutations you can sort of dream up, but let's keep it simple. Wouldn't that be nice? Well, the answer is the revenue have thought of it already. So you just don't get it. You can't get gift relief if your gift recipient is non-resident in the UK. More importantly, if you make a gift to a UK resident gift recipient and that person becomes non-resident, then gift relief can be withdrawn, so you have to be careful about that. Other anti-avoidance issues, there was a very useful, few very useful planning opportunities involving gift relief, one of which involved making a gift of shares to a company. So the gift recipient was a company and you were gifting shares in another company to a company, and I'll explain why at the end. That was knocked on the head by the 98 Finance Act. And there were also other opportunities where you could transfer, let us say, a property which had never been your main residence to a trust, trigger a chargeable transfer for inheritance tax purposes at nil, claim Section 260 gift relief, allow a trust beneficiary to occupy, and then claim main residence relief at the trust level. That was a very good fun. The revenue eventually got wise to it, so now you can't claim gift relief if the recipient is what is known as a settlor interested trust. And the definition of settlor interested is quite wide, and it includes beneficiaries who are your minor unmarried children, so you have to be careful about that. So anyway, gift relief, there's some pitfalls there, but there's some opportunities. So moving on, there is something called incorporation relief. Now, what was I banging on about before tea? I was banging on about capital gains tax, corporation tax low, good, income tax high, bad. So let's think about how this thing called incorporation tax relief works. What is it? It is the transfer, it is the relief that applies if you transfer a business to a company in exchange for shares in the company. That's simply is it. That is it. That's all you need to know, really. And how does the relief work? Well, you start off with assets that are pregnant with gain. You transfer them to the company in exchange for shares, and the shares that you own going forward are pregnant with that self-same gain. So you personally have not got rid of the gain. The gain has been transferred from the assets which were represented by your unincorporated business and are now embedded in the shares in the company that you own. Yes, and that's very, very straightforward way of thinking about it. You've still got the gain. The company hasn't got the gain. The company is deemed to acquire those assets at market value. Wow, this suddenly sounds good. So let's put an example around that. Let's be more specific. The business doesn't have to be a trade. Lots of reliefs are predicated about trading activities taking place, but this one isn't. It's got to be a business. What's a business? Well, owning investment properties is a business. If you own investment properties for gain, that is a business. So let's imagine that. Let's imagine you've got a person who owns investment properties, gets loads of rent from them, might actually want to sell some, buy some new ones, but doesn't really want to sell them because the capital gains tax payable is onerous. So he's sitting on a portfolio that he'd like to realign but can't or won't. So what can he do? Well, supposing he transfers the properties to a company in exchange for shares. no gains tax on him. His shares are now pregnant with gain, but the company has got the properties with a market value base cost now. If the company then thinks, right, that property over there, which isn't yielding very much, but which is pregnant with gain, or was pregnant with gain, not in our hands it isn't, so we can sell that. We'll sell that, we'll buy another one. You've washed out the gains at the company level. Very important point, very interesting, very interesting. Now, what else is interesting? What is interesting is, I've just been talking to you about the residence issues, how you can't possibly claim sort of rollover into something which is non-resident. Here, you can. There is no restriction on the residence status of the company. So you can transfer your business to an offshore company, a Jersey company, a Guernsey company, an Isle of Man company, if you want to, without prejudicing this relief. That is very interesting. So going forward, you have your properties owned by an offshore company. What else is interesting? Well, what's interesting is you don't have to get ordinary shares in exchange. You could, for instance, think to yourself, well, these properties are going up in value. I'm rich. I recognise that there's an inheritance tax issue here. What I'd like to do is, if nothing else, freeze it. I don't want it to get any worse. So what I'll do is, I'll get my children to form the company, and they'll own the ordinary shares, and I'll transfer the properties into it in exchange for preference shares, for instance. So all the growth in value of the properties will then flow through to the ordinary shares. My preference shares will be fixed in value, and I've frozen my problem. That's an interesting concept. Are there any anti-avoidance rules that abound? Well, if you were to incorporate an offshore company, you'd have to be careful about some general income tax anti-avoidance rules. You wouldn't be able to shake off the income tax liability very easily because there are some funny rules about transferring assets abroad, but you'd have to accept that. You'd have to take those on the chin. But otherwise, you don't even have to claim the relief. It's an automatic relief. With gift relief, you've got to remember to claim it. I had a very interesting case where a chap did one of the schemes that involves transferring shares to a company, the idea to get his business into an offshore company, and he got a funny letter from the revenue. And he said, Steve, it is all right, isn't it? It is all right. What I did, it's all right. And I said, well, yeah, what you did, it's nothing to do with me, Paul. At the time, I was nothing to do with you. But yes, what you explained to me, it's perfectly all right, perfectly all right. I assume you claimed the relief, didn't you? What? Claimed the relief? I didn't have to claim the relief. Nobody told me to claim the relief. And I said, if you didn't claim the relief, it's not all right, because that was predicated upon a claim. You've got to make the claim. If you don't make the claim, you don't get the relief. This one, you don't have to claim anything. You get it automatically. In fact, you can turn it on its head a bit. You can disclaim it. Because you get it automatically, you can say, I don't want it. Why might you not want it? You might not want it if you thought, I'll pay tax now at entrepreneur relief rates, for instance, because I think they're going to go up, or I might not qualify in future. Now, there's two reasons why you might do this. Why do it is my final point. Why might you do it? Two reasons. Reason number one, I alluded to earlier, to enable your profits to be rolled up at company rates and to get a tax-free uplift on, let's say, a property portfolio. It's a very compelling reason. The other reason is if you are of Indian or Pakistani domicile. If you are of Indian or Pakistani domicile and you own UK situated assets, you are liable to inheritance tax on those assets. However, the UK has two very peculiar and old capital tax treaties with India and Pakistan. The effect of which is that if you own property which is not UK situated, i.e. shares in an offshore company, you don't pay inheritance tax on it, even if you've been resident here for donkey's years. Even if you're deemed domiciled for inheritance tax purposes, the deemed domicile rules came in way after the tax treaty is in question, there is no inheritance tax. So this is a particularly interesting structure for people in that position.